Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra. Well, the recent news that has spooked the D Street is the RBI's surprise move on the rate hike front. Now, this rate hike has not only come as a shocker to the borrowers, but also the stock markets that have not taken it too well. While one was really preparing for the reversal of policy, this out-of-turn policy rate hike announcement is something that has disturbed the sentiments on the D Street. Now, there are questions that remain unanswered, and to understand the implications of the rate hike done and the RBI's actions. Joining in is a very special guest with me. I'm joined by Mr. Dharmakirti Joshi. He's the Chief Economist at Crisil. Welcome, Mr. Joshi, to Business Today TV. Thank you for taking the time out. Appreciate you joining in, sir.
My pleasure.
Sir, I wanted to begin by understanding from you this out-of-turn policy rate hike announcement. For sure, it has, spooked the street sentiments. But do you really believe that this will solve its purpose, that is to tame inflation?
Well, I think the RBI is the goalkeeper for inflation. So I think that's the primary responsibility of inflation control is with RBI. And central banks typically look through the inflation when it is out of supply shocks. So this is largely due to global factors. And it's essentially shock from fuel and commodities, I think, particularly the crude. So what you would have noticed is that central bank was gradually moving towards tightening in some sense, because first they became tolerant of yields on government bonds going up. Then I think following that, they gave a signal in the March policy that inflation is going to be much higher than what they expected. And now I think, but this policy move was not expected. I think, let me be at least I didn't expect it. And this was more than what we expected in June. So this was 40 basis point. And then they also had a CRR increase along with it. Now, so this the purpose of this move is to address inflation. I think that's primary purpose. Now, the interest rate hikes do not reduce food inflation or fuel inflation. That's pretty well known. They have their own dynamics. But what the interest rate hike can do is it can reduce the transmission of food and fuel to other sectors of the economy. So which is called the second round effects. So I think that this policy will essentially address the second round effects. So in a way, I think it is better to have a rate hike than not to have it, because otherwise the upside pressure to inflation will be much higher than what it currently is.
Okay, understood that point, sir. Could you also help us further understand whether Mint Street and North Block are on the same page when it comes to tackling inflation and the way of tackling inflation right now?
The way RBI controls inflation is through interest rate hikes, reducing liquidity in the system, which they have started doing. Now, the parallel move by the contribution of Finance Ministry to this is that they have started reducing duties on some of the items, like edible oils and even petroleum products, which was done a couple of months back. So now this supply side inflation can be better controlled through fiscal policy than monetary policy, because as I pointed out, it kind of addresses the second round effects. If you address it at the root, then I think it has to be done by duty cuts, etc. But there is a trade-off. I mean, government also needs money to spend. So I think if it starts reducing duties, then it will find it difficult to address issues like food subsidies, etc. So there is a trade-off, and they have to do a balancing act. So right now, I think my sense is whatever space is there, I think that is being utilized to address inflation. By the way, this is a worldwide problem now. I mean, it's not India alone. I think where many countries are facing extremely high inflation.
Absolutely, sir. So now one part of the rate hike is that the RBI hopes to tame inflation, which time will tell how much of it will be done. But could it also adversely impact growth now, which is already slowing down in its pace? Can it stall the recovery that we were seeing post-COVID?
Well, I think the way monetary policy works is, I think it addresses inflation via growth. I mean, it kind of, but the point is that right now the policy is still ultra accommodative. We economists look at real interest rate, which is inflation rate, interest rate minus inflation rate. I think that is still negative. I mean, so it is still in an accommodative zone. Interest rates have not shot through the roof. But I think as a counterfactual, I think if they had not done this, I think that would have been more growth supportive than it is currently. It's not going to choke growth, But yeah, of course, I think it is adverse for growth. I mean, particularly if interest rates rise too much. I mean, right now we are still at the pre-COVID level. I mean, so it is still quite soft. I mean, I would say.
Right. I ask you this because, I wanted to understand, are we still on track with the V-shaped recovery that everybody was talking about post-COVID, or has that trajectory changed?
Well, I think the V shape happened in 2021-22 because I think the growth came down from 4.5 to minus 6.6 and then again went. So you already had a V. Now I think you will not get what you are looking for now is that whether that momentum will be sustained. I mean, so we are over the V thing. Now we have to now somewhat momentum is getting compromised because of global developments. World economy is going to slow down, so your exports are going to slow down. Monetary policy tight means it's not very supportive of growth, although it's not that tight as I pointed out. So I think there are many factors which work against growth, but there is a strong momentum also. I think the segment of the economy which was hit the most, this contact-based services, is showing an extremely smart rebound. I mean, whether it is tourism or it is hotels, I mean, it's very difficult to get there's no bargain right now. I think it's rather, I think you have the inflation is also rising in services, demand is also rising. So my sense is that the growth story of 22-23 will be of services. I mean, the contact-based services, because even if COVID fourth wave is growing up, but it doesn't seem to stop people from consumption of services. So I think this year will be a year of services. I think
okay. Okay, the year will be of services and contact-based services, which is showing sharp growth as of now. But I also wanted to have a deeper understanding of, perhaps why has the RBI taken this out of turn, decision to hike rates? Because this 40 basis point hike has just come in after just a month when RBI was perhaps fully comfortable with the situation, including that of inflation. What do you think has dramatically changed from then to now, and why this hurry? Why couldn't it wait for the June policy?
Well, I think the central bank and all the analysts, I think, have been surprised by the speed with which inflation is rising. I think the print that we saw for March was close to 7%, and we expect that April inflation will be around 7.5%. So this is a big shocker and a surprise. Now, I think they didn't plan for, when they made the policy statement, they weren't expecting this kind of a jump. So there is a big surprise that came from inflation, and I think they are also addressing it by a surprise from by another surprise from the monetary policy, which is out of turn interest rate hike.
Okay. Also wanted to ask you, sir, say how many more rate hikes do you believe the RBI will have to undertake now to rein in this skyrocketing inflation?
Well, I think it's a little difficult question to answer, but what I would say is that since they have done a 40 basis point, they'll follow it up with immediately, maybe in June also, you will see another 25 basis point. So you'll have front-loaded rate hikes. After that, I think it will be wait and watch. I think so. We expect 75 to 100 basis point further repo rate hike in this fiscal year. That's our expectation.
Okay. Could you also help us understand what will be the impact of this 50 basis point hike on the CRR front? We understand, as per the RBI governor's statement, that the liquidity to the tune of 87,000 crores will be sucked out from the system. But how will this really impact the overall economic performance?
Well, I think there is liquidity and there is excess liquidity. So right now we still have a situation of excess liquidity. So they are trying to cut the excess part, but they will still keep the liquidity for productive purposes. But when the excess liquidity gets cut, then there is an upward pressure on interest rates, the bonds, etc., which we have seen pick up. So I think the impact is obviously, there are two tools. One is through liquidity and other is through, when you have liquidity tightening and interest rate hike, then it becomes more potent. Then you will see quick transmission of rate hikes into the rest of the economy.
Right. But do you think that this will create further growth problems for the smaller and medium enterprises, those enterprises that were most affected by COVID-19, and this liquidity support was given to the economy so that these, more vulnerable sections of the economy could actually sustain the shocker?
Well, I think they get hit more. There is no doubt. And interest sensitive sectors get hit the most. I think for them, some kind of support will continue. I think when RBI says that it is still going to be accommodative, I think it's probably hinting towards those segments, because the larger corporates are enjoying extremely good financial profile. They don't need to borrow right now. They have excess reserves with them. I think it's the smaller guys who need support. And I think for them, my sense is if rates are rising, I think they still need to be supported so that they can so that the policy becomes a bridge for them to cross over to the other side. I mean, otherwise
Okay.
it's a challenge.
Okay, understood. And last question to you, sir. What are you penciling in terms of your growth outlook now, given the changed macro setup, the higher inflation rates, the upcoming rate hikes that could now come in for FY23? What are you penciling in?
Well, I think our current forecast is 7.8% growth and 5.4% inflation. We are in the process of revising it. So I think so it will take about a week for us to factor in all the variables. And I think maybe by next week we should come out with a firm number on our outlook. Right now, I can only say that there is an upside risk to inflation and a very strong downside risk to growth. So I think that's where we stand right now.
Okay, and upside risk to
higher inflation.
Okay, so lower growth and higher inflation, perhaps one needs to brace up for that reality going forward from here. Thank you so much, Mr. Joshi, for taking the time out and speaking to us, and to all our viewers, helping them understand what the latest rate hike really means for the overall economic scenario that we are faced with now. Thanks a lot for tuning in with us.
Thank you very much.
If you like the video, do like, comment, share and subscribe.